Bond Turmoil UK May 2023 is what I've entitled it. It actually has a bit of ramifications to 15 years ago, of course, May 2008, when the financial crash was just kicking off. But anyway, let's see what's happening in the world. Now, to understand what's happening to interest rates, because if you're a mortgage broker, unless you've been living under a rock, you've noticed that fixed rates are edging back up again, which is not good, really. And there's different rates coming through. That affects the equity release marketplace, etc. So let's take a look at the bond market first of all and see what's happening and why we've had a few problems. So if I just put up my little whiteboard here, the bond market, so I'm going to put a jolly big sort of square there to indicate a marketplace. Now here we have the UK bond market. Now what we're talking about here for the UK bond market are the stock exchange, effectively, for people buying and selling UK bonds. Now when we say bonds, we're talking primarily about UK government gilts. People buy and sell these things on the market. On the stock exchange, we're talking about existing gilts, buying and selling. Now when you buy and sell something that's on the market, you have to set a price. And what's been happening is that prices have been coming down. So prices, if I put that little indicator there for you, prices are coming down on existing government gilts because people buy and sell them, you see. Now if the prices come down, then the yield, this is the big one for you, the yield goes up, because it does, and we can show you calculations to prove that. And that's the problem, you see. Gilt yields are going up. Why are they going up? Well, there's a couple of reasons, which I'll give you in a second, which happened last week. But there's a few underlying principles in the bond market which we can't help happening. Now, how do we get bonds into the bond market? Well, first of all, there's a whole load of existing bonds that have been issued over dozens of years in the past that have been bought and sold by foreign companies, foreign countries, investment trusts, etc., unit trusts. But there's an awful lot of new bonds coming in. And what's worrying actually is the government, the UK government, need to issue, just get the figures for you, 240 billion of new gilts this year in 23. And that's going into the bond market, which increases supply. Of course, if something is heavily in supply, prices come down. Anyway, so 240, we've got to basically fund the government spending by an awful lot of money this year. That's post-pandemic, etc. as well. Now, you've also got Bank of England. Now, the Bank of England, as you know, did a lot of quantitative easing over the last few years, loads in the pandemic. Now, they've reversed that, and they're now throwing these bonds back on the market, because they bought a load of bonds, you see, with printed money. They're now throwing these bonds back on the marketplace. And I mean, there was something like 0.75 trillion that they own, something like that, the numbers. Anyway, they're piling them back into the marketplace to sell them. So not only have you got existing bonds, you've got the new stuff coming the government want to get rid of, and you've got the Bank of England shedding off their old stock. So supply has rocketed, and that's causing a lot of the turmoil. So what else has happened then? Well, the markets have been spooked. Why have the markets been spooked? Here we are. And we're talking here about the people who buy these things. The people who buy bonds have been spooked. And these people, who are foreign companies, foreign countries, sovereign wealth funds, pension funds, investment funds, these are institutional investors. They've been spooked because the economy in the UK is not looking so healthy. The big problem was the inflation figures came in. Now, as you probably read about, inflation was down, which is great, but underlying inflation wasn't. Food prices have trickled down a little bit, but the inflation has been burnt in now to the economy. Now, I remember the 70s and 80s. I know I'm showing my age there, but I remember when inflation was burnt in. And what happens then is that people want pay rises all the time because they can't afford to live. So they get pay rises, and what companies then do is to pay those pay rises, they increase their prices. So you get this wage price spiral, they call it, where wages are going up all the time. So prices go up to compensate, to pay for the wages. People can't afford anymore, so they want more wages. And to add to that, two issues in the economy. Number one is we do have high employment in this country, which means that hardly anybody's unemployed, unless, of course, you don't want to, because they're trying to get the over 50s back, aren't they? So everyone's got a job, pretty much. So they can bargain now with their employers for higher wages. We're quite unionised as well still, particularly in the public sector and the post-public sector, the rail track, etc. So they're good at collective bargaining, aren't they? So they're pushing up wages, which people should have a higher wage, but this is the wage price spiral, and it's out of control. And the Bank of England, I'm not going to judge them because they do a great job, but they have missed a bit really, and they're putting rates up again. They keep putting up the bank base rate in order to stultify the economy, to stop spending, to stop people being, having spare money in their pockets. And it's beginning to work because fixed rates are being renewed. People are feeling the pinch. We all thought that the last rate rise was it, but it looks as though there's going to be a few more. So the Bank of England base rate will probably go up. Now, what's happening here then is that the markets have been spooked. The markets who buy these government bonds, which underpins the UK economy, and they want to have better prices. They want better yields. It's the key one. So the yields are going up, prices are coming down. That affects fixed rate mortgages. As you know, fixed rate mortgages are based upon two things really. They're based upon the gilt prices, gilt yields. That's what they're based upon, fixed rate mortgages, and expectations of future interest rates. That's what determines a fixed rate mortgage 2 or 5 years. And if yields are going up and there's expectation of future interest rates, then fixed rate mortgages are going to get higher and maybe will remain high for the rest of the year. So work it, guys. You need to work this. It ain't going to go away. You've got to work your business model to accompany this. And there's lots of issues that you want to be looking at. Of course, the rates are quite considerable. Just to sort of show you the numbers there for you. Here's some figures out today. You'll notice there's equity release rates at the top there, but it's the 15-year UK gilt rate I wanted to show you. So 4.2 was the yield last week. It's now 4.58. As you can see, it's gone up by 0.29. So the yields are going up. So, keep an eye on those. Keep an eye on those figures because there's a turmoil in the marketplace. But I hope that's quite cleared it up for you.